We're going to recap the year's worth of sales for quite a few markets across North America, US and Canada included. It's going to include total sales, year-over-year sales growth, what the average basket size was, brand consolidation, looking at when sales peaked. That's right, sales have peaked out, and yet we have at least seven markets that made $1 billion each. We're going to cover all of that coming up.
It's only entertainment.
Welcome back to the Talking Hedge. I'm Josh Kincaid, capital markets analyst and host of your Cannabis Business Podcast. Looking at total cannabis sales in California, we're going to look at Colorado and Nevada, Washington State, Oregon, Arizona, Illinois, Massachusetts, Maryland, Michigan, and Pennsylvania, as well as up in Canada. We'll look at Saskatchewan, Ontario, Alberta, British Columbia, just kind of give us a broad overview of what North America is doing, including peaking out in sales in August. So California tends to be kind of a bellwether, a harbinger, tells us what's going to happen typically in the industry. So 443.3 million in sales was the first dip, and they've dipped every month thereafter and still made over $5 billion in the year. Pretty substantial. So right behind them in second place is Colorado, but they've dipped too several months, 5 months in a row. Even their medical marijuana sales have dropped 25%. 140 million for the month for December in Colorado, but 1.8 billion for the year. And then Michigan, 1.66, kind of the wild, wild west out there in Michigan, 153 million for the month, but 1.6 billion. The other $1 billion states that we see, Illinois, 1.3, Massachusetts, 1.2, Washington State, 1.4, Oregon, 1.2. Close runner-ups, Nevada, 862 million, and then at $750 million for Pennsylvania. And all right, so you can see month over month sales for Pennsylvania and Saskatchewan, Ontario, Michigan, Maryland, Massachusetts, Illinois, and Alberta, all right here on this graph that I created. Somewhat interesting markets, Illinois being almost 3 times that of Alberta, for example. Michigan, still doing some pretty good sales, more than Ontario. So it looks like some of the Toronto regulations and everything may have hurt some tourism and or overall sales. Don't really know. Saskatchewan, not too much of a surprise. I think you'll see that in kind of rural areas, the Wyomings and Utahs and lower population states or provinces, they'll see less sales, obviously. But I will point out that sales peaked in those markets too. Alberta's dropped all 5 months since August. Looks like Massachusetts has, it's still an emerging market, but it is dropping, just not like other states. Michigan's still fairly new, but it's dropping too. Year-over-year growth is obvious. When you're looking at California, it was 33% in January compared to 1% in October. In the month of December, it was 6%. So you're looking at double digits in Colorado. Every state had double digits. Alberta, 73% year-over-year growth in January, negative 1% in December. 195% year-over-year in Michigan, 67% now. Oregon, 35% to a negative 2. You're seeing a lot of negatives in there. Negative 4% for Washington, negative 3 for Nevada, 0 for Colorado. Illinois went from 341% to 42%. Ontario went from 158 to 71. So substantially coming way down in terms of year-over-year sales growth. People are really cutting back. I think the major part of it is that inflation isn't transitory. It is here and people are feeling it. So maybe there's a direct connection to the Great Resignation and, people not wanting to get vaccinated. a lot of people are getting laid off, from police to firefighters, teachers, airlines, even Amtrak had to say, okay, we're not going to do this anymore. We're losing too many people. A lot of healthcare industry workers are moving from New York to Florida. It could be the greatest migration in history. 10% after World War II, 10% of the population in the United States migrated after World War II. We may see the largest migration ever, or at least since then. And so people are starting to feel that pressure, and there's inflationary pressure, there's costs and everything else, and people are really pulling back. So if they're pulling back on their vice, you know that they're really struggling everywhere else. Housing is all-time highs, groceries and bills, and everything is really expensive. So if you're starting to see it trickle down into vice, then I think we're on the precipice of a massive correction, if not recession. Looking at the number of transactions is simply revenue and number of times people are going in. So on average, you're looking at California, $67.12, which makes sense because delivery was a $65 minimum. So on average, in June, people were spending $67.12. It has since come down below that delivery minimum. And first happened in August and has been going down. The average for the year, $65. That is the highest for this particular area. And then let me go over here. I'll show you that Illinois, $103 on average, 107 in Maryland. But you look at the other, markets back in Washington, and you'll see that $34 in Washington, 41 in Oregon. That's going to be more norm, unless they kick in delivery. So Washington, we don't have delivery. If they made delivery and said $65 average delivery price, you'd see that skyrocket, basically. But what we're seeing is people spending less. And so in California, if the average basket size is less than the delivery amount of 65, it's telling me that a lot of people are going into the store and spending less. And there's other data that backs that up, and we'll get into that in just a second. But take a look at all of these months with the average. You can see it happened right after June, slowly coming back down. So in California, $67 to $66 to $64 on average per month of what people are buying, down to $62, $61, just kind of keeps coming down. And it doesn't look like it's stopping. Same source sales look like they have peaked. And until they have new SKUs, it's going to continue to, I think, decline. People are really kind of pulling back, it looks like, fairly significantly. And so I can tell you that because if you look at the amount that they're spending is dropping more and more, but in fact that they're going into the stores more often. So the count of baskets is the number of times that they're going in. So we're seeing 6.4 million visits in June versus 6.8 million in December. In California, that's telling me more people are going in. Obviously, numbers are right there. It's increasing because they can't take advantage of delivery any longer because they don't want to spend that $65 minimum going into the store more often. But seeing an increase in Colorado, decrease in Nevada, decrease in Washington, decrease in Oregon, about the same in British Columbia. So it's about the same in Alberta and Illinois. All of these newer markets. Massachusetts is about the same in Michigan. Ontario is increasing. So definitely seeing it, people going into the store more often in Ontario, maybe taking advantage of the delivery, as their prices, average price went from $51 to $44. So definitely coming down in those big city areas. Saskatchewan hasn't changed at all. Smaller markets haven't really been affected. So less tourism, less people spending. Not really sure. Pennsylvania, fairly stable, but definitely coming down on their average item price, but the number of baskets is increasing. So that's kind of an interesting note where I just think that people are going in more often and spending less. Brand concentration is interesting. It's the top 10 brands and how dominant they are. And so it's about a third in some of the vertically integrated states, California, Colorado, 38%. Washington and Oregon, 22%, a lot more competitive versus some of these other areas. So don't have a lot, in some of these markets to show, unfortunately, with the exception of, I want to show Pennsylvania because it's crazy. They own 75% of the market. That's the first mover advantages and being able to get in and dominate the market. Now, whether or not they can have the product and quality and consistency to keep that, I don't know. But starting off with that is very, very fortunate for them. Not really for the consumers, though. They need more product types. Like I mentioned, Washington State being some of the most competitive markets in the world, 2,000 SKUs on average in some of these stores. It makes it really, really hard to find a product you want, requiring some of those bud tenders to give you their recommendations or whatever. But if you're going online ordering, pre-orders, or you're in a state with delivery, you're not really going to get that. So seeing that the concentration is anywhere from 20 to 30% for the top 10 brands owning that market share. Luckily, it's not more. I think we're going to see more consolidation, though, as we see more price pressure on the consumer shifting. And so some of the obscure products are going to go out. Some of the brands that people don't relate to can be gone. Some of the things that are too expensive are going to have to either lower the price or suffer the consequences of having less transactional volume. So what we are seeing, all in all, prices going down, people changing their vice habit, not a very good sign. I think, again, this has to do a lot with the inflationary pressure and housing costs and groceries and all of that. So I would anticipate that if this is some kind of bellwether event, that we should see kind of an economic crash. I don't know, soon, maybe within 18 months, if this is accurate and people are really pulling back. If they're pulling back everywhere else, it's just a matter of time before kind of the economy takes a hit and has to recover from that. So I guess we'll find out.
With that, we're going to roll this one up. I'm Josh Kincaid. This is The Talking Hedge. Don't forget to like, share, and subscribe, or don't, and I'm out.
Don't forget to smash that like button on your way out and check out these other videos that we've got.